Coinbase, Tesla, right? We're going to talk about all of that. We're also going to talk about China growth disappointing again. Janet Yellen, U.S. Treasury Secretary, making some comments about that and what it might mean in terms of a U.S. recession. And then your world, Ford. What's up with Ford, Matt?
Yeah, they're cutting prices on the F-150 Lightning. And I think it's so fascinating because until now they've been raising prices there. They're the only player really in the EV pickup space. Okay, there's a Rivian, but that's not really the same thing as a full-size pickup. Now Chevy's coming out with one.
Right.
Tesla started
producing
the Cybertruck, and with competition, you know, comes a little bit of a price action, and this time to the downside.
Aren't prices supposed to come down at some point so we can all afford them?
Well, usually prices in the auto world just go up and stay there, up and stay there, up and stay there.
What is it, like, you know, getting a college degree? What is this? No. All right, we're going to talk about that. We've got the Bloomberg Big Take. It's on the fun giant Vanguard. Also, Bloomberg's Brad Stone on Hollywood finding its perfect villain in AI. This is a fun read and fun take on what's going on. And then we're going to talk with the president and CEO of the Fearless Fund. It's not a quiet Monday, kiddo.
No, there's a lot going on today, and there's a lot of action in the markets as well.
All right, now, though, we're going to head over to our TV colleagues because Countdown to the Close, it starts right now.
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Romaine Bostic here alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio, Originals, and our streaming partnership with YouTube. An interesting day here in financial markets, up pretty much across the board for equities here, but still some broader concerns about global economic conditions.
Love that you went there. Thank you for the setup, Romaine. We're talking about China specifically. We did get some growth numbers for the second quarter, 6.3% from a year ago. Sounds kind of high. We would take it here in the U.S., but slower than expected. And if you look at the growth in GDP, we're talking about a 0.8% rise from the first quarter when it was 2.2% in terms of the increase. So there's concerns. We see Morgan Stanley, we see Citi slowing their growth estimates for that nation. And, you know, Matt, when you look at China, there is a global impact. And we actually had the U.S. Treasury Secretary weighing in on that.
Yeah, she told us in an interview this morning with Anne-Marie Hordern that, yes, the slowdown in Chinese growth is going to be problematic for a lot of countries that depend on China as a growth machine. It's going to spill over into the U.S. as well. However, she does not see a recession, and it's always good when the U.S. Treasury Secretary doesn't see a U.S. recession. She says it's because the labor force is so strong and prime-aged workers continue to come back into the market. And by the way, I just did a little bit of research, and it turns out I'm still in my prime.
All right.
So I'm pretty psyched about that.
No, I don't think so.
I think you haven't even begun to peak.
When do we issue that correction?
Oh God.
Ooh, 10 points from me.
Maybe in an hour. It was interesting to hear her talk so much about the labor market, though. Of course, that's sort of been the pain in the side of the Federal Reserve. Not that they want to crush the labor market, but you think about the sticky components of inflation. It seems like it ties back to just how resilient jobs are.
But if no recession, why do you have a market that still seems to be trying to price in rate cuts relatively soon? It was interesting commentary that we heard from Richard Clarida, former, of course, Fed vice chair, really talking about this idea, saying that not only is he seeing a lot of those wagers come in for rate cuts by the March meeting, but he actually thinks that they might actually be justified.
Yeah, that was one of the stories that was top of my list this morning. Basically, that if we got rate cuts in March, that would make a lot of sense. Not a lot, but maybe a little. If you think if there's going to be a softish landing, if the Fed really does get inflation under control, and it made me think of the fact that, okay, even if we don't get a recession, rates are firmly in restrictive territory right now. At some point, the Fed is going to have to cut rates just to get out of restrictive mode.
Well, what struck me, too, is I feel like in his comments he said, with a more rapid slowdown inflation bringing about those rate cuts, he said stubborn price pressures may mean that they will actually be delayed until much later in the year or even further away. Like, I felt like he played both sides of the argument. And it also made me think about Jay Powell, right, recently or in the latest FOMC meeting, saying that, wait a minute, rate cuts are years away. So I don't know. I don't think we really know.
Well, he said that, right? But the dot plots show rate cuts already next year. So his colleagues don't agree with him, and maybe he can get them on board before the next meeting or the following meeting, but probably not every meeting for the next few years.
Right? They're so unanimous.
I thought it was interesting that Scott Ladner over at Horizon Investments pointed out, Inflation is no longer concern number one. Growth is now concern number one, which is why we're talking about rate cuts.
Yeah, and we've heard that from some other strategists, too. It'll be interesting to see how that affects the price action over the next few weeks and months, guys.
Yeah, that's what it's about, right? Valuations against the economic backdrop. All right, guys, quick. That's done. We'll be back, though, in less than an hour's time. Our cross-platform. We're going to continue Market Chat on radio, TV, YouTube, and, of course, Bloomberg Originals Beyond the Bell. Join us at 4 p.m. Wall Street time. All right, everybody, you are listening and watching this Monday edition of Bloomberg Business Week. Carol Massar along with Matthew Miller live in our Interactive Broker studio on YouTube and Bloomberg Originals. Matt, of course, in for Tim. China on our mind today. We want to stay with that story. We just talked a little bit about the setup in terms of 6.3%. That's the growth in China for the second quarter versus a year ago, slower than expected. And we've seen a slowdown in the pace of GDP growth from the first quarter to the second quarter. So let's see exactly what that means. And again, as the backdrop, we also talked about U.S. Treasury Janet Yellen. She made some comments to our Anne-Marie Hordern about what the impact of China's slowdown means on global growth and what it means about the U.S. in terms of a possible recession. Just a little bit of what she had to say.
Growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging.
Of course, that's U.S. Treasury Secretary Janet Yellen earlier in an interview on Bloomberg TV with our Anne-Marie Hordern. All right, so let's get to it with China in certainly on our focus. Bloomberg News global economy reporter Enda Curran joining us on Zoom in our Washington, D.C. bureau. Enda, so nice to have you back with Matt and myself. Talk to us about the slowdown in China and how you see it in terms of the global impact on growth.
It looks to be pretty material. New data on Monday showed the slowdown in the retail sector, consumer spending, much more disappointing than expected. We know, of course, that the real estate story remains in the doldrums. Youth unemployment now well over 20%. That's a record for that data set. The data set only goes back to 2018, but nonetheless, it shows the pressure young people are under to get work there. The upside surprise came in industrial production, suggesting that factories are getting going again. But we know the export story is still pretty much in the doldrums too. So there's no doubt China's economy is certainly slowing down. There's chatter now among economists that it might even miss the growth target of this year, 5%. Mm-hmm. That was considered to be conservative. And the point is, China was meant to be the big rev up for the global economy this year. Post-COVID zero, Chinese tourists would spend money and China would import lots of goods from around the world. It isn't really playing out like that. It's proving to be something of a very disappointing year, I think, for China.
Are they going to be exporting? Are they going to be exporting deflation? Enda, is that a real problem for China? Prices coming down rather than going up?
Well, there's warnings of deflation in China, that's for sure, Matt. Whether they export it or not, that's a whole rabbit hole when it comes to economic debate. There's a lot of variables in that because you have to consider the correlation between PPI and CPI and, the role of exchange rates and who's absorbing costs and who passes on costs and vice versa. So, look, at the margins, you'd have to say if Chinese producers are facing, let's say, even deflation, then that certainly won't add to upside pressure on inflation around the world. But it's not going to be a game changer, I think, when it comes to U.S. goods inflation.
Help me understand what is increasingly going on in China in terms of their economy. And I think that youth unemployment is also very interesting. I mean, if the youth, we talk about how that can be an issue for developed nations in a big way. But I just wonder, what is it telling us about intrinsically and about what's wrong with the Chinese economy right now? Or is it just going through shifts and it's going to just take a while?
There is a shift underway. I mean, in terms of what's happening with youth employment in particular at the moment, they've had a record number of graduates come on the market this year. Obviously, that's proving difficult to absorb. There's been that big crackdown on the technology sector, which means the go-go years are over. So obviously young graduates used to walk into those tech giants like Alibaba, Huawei and get jobs before. That kind of low-hanging fruit's gone. So that's kind of the here and now. But bigger picture, though, you are right. The economy is clearly going through a shift. And it's interesting that the authorities aren't rushing to come forward with any kind of fix-it-all stimulus. They seem to be willing to take some kind of pain to make sure the economy gets off its addiction to debt and maybe gets somehow rebalanced again away from sort of the old models of heavy spending on infrastructure and the like, and making sure it does get set up as a consumer-driven economy. I mean, that's a big picture take on it, but right here, right now, that doesn't mean that won't do much for those people who are looking for a job. It's clearly pain in the economy. The post-pandemic slump, I think, has come as a surprise to a lot of people, including policymakers there, judging by the commentary in the official press. And as I say, it doesn't sound like they're willing to come to the party with massive stimulus in the near term. They're willing to absorb that pain in terms of what they're trying to pursue here.
You know, Janet Yellen was asked about her plans to de-escalate tensions between the U.S. and China, and you know, the Trump-era tariffs that are still on. Is there any chance that we take some of those off? Have those been problematic for China, those tariffs?
Well, there is a 4-year statutory review going on in the U.S. at the moment. That's just standard. I think politically, there's no suggestion that the U.S. I think will unwind those tariffs. Some people say it would help on the inflation story, but it wouldn't be a game changer for inflation here either. But so to your point then on the Chinese side, I mean, they've hurt exports at the margins, but then, you know, a lot of some Chinese producers have shifted from China to countries that are not under US tariffs and have merely rubber stamped their goods in that country and sent it across to America then, and thereby escaping the tariffs. That's been a well reported on feature. I don't think tariffs are the reason that Chinese exports to the US are declining. I think it's mostly about fading demand, coming off the pandemic highs. World trade is in a slump. So, you know, there's an ideological argument about tariffs, but I think if those tariffs are taken off overnight, it would neither be a game changer for US inflation, nor would it be a game changer for Chinese exports.
What's the impact, though, on global growth? Should we anticipate that everything's got to kind of do a reset, folks, because the second largest economy, right, in the world, having some issues?
Well, you know, it's interesting. This is what I was trying to say at the start, that the story was meant to be Chinese tourists go everywhere and spend lots of money. And on the flip side, China would be importing lots of services and goods from around the rest of the world. Neither of those scenarios are playing out. And in truth, some economists are saying the rest of the world is kind of moving along just fine without it. I saw one note from UBS this morning making the point that the China slowdown isn't really having much of a spillover on anyone. And Janet Yellen made that point in the interview with Bloomberg Television this morning as well. She said there will be some spillover to the US, some spillover to Asia regional trading partners, but she doesn't think it will be enough to send the US into recession, for example, citing the strong labor market here. So I think it's interesting. There's a school of thought now asking the question just what China's slowdown will mean and how specifically it will impact trading partners.
Right.
Okay, go ahead.
Well, I would just, we think about it for us, but I wonder how much of a problem it is for Xi Jinping, right?
Right.
If you've got more than a fifth of your, I don't know what youth unemployment means in terms of age, but they probably want to have jobs, right? We're talking about 18, 19, 20-year-old kids who can't get jobs. That's going to be a problem for the Communist Party, isn't it?
Yeah, I think it's a 16 to 24 bracket.
16 to 24.
Bracket. Yeah, but absolutely, it's a political imperative. The whole social contract of the party is that they will provide jobs and economic stability, and that's the deal. Obviously, it is an imperative for them to create jobs. They speak about it all the time, and that's why it's interesting that the youth unemployment indicator is going in the wrong direction for them. And I would imagine that you will see a lot more focus on this as we head into the back end of the year. The back end of the year is when some big economic policy decisions are made in China. So I'd say you'll see a lot more focus on that.
Well, and I do wonder, too, I was reading something this morning, some analysis that, you know, and because China kind of is just not getting out of the pandemic malaise like everybody thought, even though it is still growing, that maybe it will be more inclined to loosen up in terms of some policies, but also some of the geopolitical tensions, because it kind of needs to maybe play ball on a global scale to help its economic engine.
I think that's a very valid point. I mean, it's already happening. You've seen China go around Europe. Li Qiang, the premier, went around Europe recently, and he was making a direct pitch to companies, telling them, listen, don't worry about the politics, leave your governments one side, come and do business with us direct. There have been other kind of overtures from China as well in terms of we're open for business, you know, come on in. But sentiment seems very negative towards China at the moment, not just politically, but economically as well. People are questioning some of the stories around the famous middle class sort of opportunity that many consumer companies talked about for years. I think a lot of people are rethinking China, as I say, not just politically, but questioning where exactly are the economic opportunities there at the moment. So, but nonetheless, we don't see a wholesale withdrawal of companies from China. That's not going to happen because, of course, there is an opportunity there for some.
Yeah, I just think it's an interesting time in terms of the world and maybe changing dynamics. There was an interesting story, I think, too, and I don't know if you saw it in the Times, just talking about, where the growth is going to be in the future. And a lot of it has to do with demographics, and they talked about India. But, China's facing aging demographics, the U.S., a lot of Eastern European countries, and I feel like that could potentially be a big factor as well.
Got to make more babies.
Make more babies and allow immigrants in. Is that, though, something that's also on your radar? Just about 25 seconds.
Yeah, immigration, no. For China, make more babies, yes. But remember, China offers scale. Nobody else has scale like China.
All right, listen, thank you so much. So appreciate it. Certainly a top story on our radar today. Enda Karan, who's global economy reporter at Bloomberg News, on Zoom from our Washington, D.C. bureau. People used to have lots of babies, Matt.
But not in China.
Well, there was a reason why.
They had a specific policy limiting that, and now they can't convince people to do the opposite.
Exactly. All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio. Carol Massar, Matthew Miller, and this is Bloomberg.
Connection lost.
Market markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, and NASDAQ all holding very close to session highs. 39 minutes to go ahead of the closing bell. With the S&P right now up 23 points, a gain of 0.5%. The Dow's up 132, up by about 0.4%. NASDAQ up 1% now, higher by 148 points. 10-year yield 3.80% with a 2-year that's yielding 4.75%. Spot gold virtually flat on the day, up just about 50 cents the ounce, while West Texas Intermediate crude is down 1.7%, 74.14 a barrel for WTI. Stocks are resuming a rally as investors weigh bets that the Fed is approaching the end of its rate hike cycle against evidence pointing to a slowdown in China's economy. As for the market backdrop, specifically inflation, Kelsey Barrow is fixed income portfolio manager at J.P. Morgan Investment Management.
The Fed has a forecast of 3.9% for core PCE by the end of the year. We think they're going to get there, and they're going to go even further. Inflation is going to move down even further. So for us, what we're seeing is the Fed is going to be able to pause, and it's going to be a function of this inflation data coming down faster than the Fed projects.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Marriott International is gaining a major presence on the Las Vegas Strip with a deal that lets loyalty members use their points for stays at MGM Resorts International Properties. Today, Marriott shares are up 1.3%, MGM little change, down less than 0.1%. We are just under an hour away from our interview with Kathy Wood of ARK Investment Management. You can hear it live 4:07 p.m. Wall Street time right here on Bloomberg Business Week. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Matt Miller in for Tim Stenovic on this Monday. Got to talk a little bit more about Ford, basically hovering near its lows of the session, still down about 5.6%. This as the company is slashing prices on the electric version of its best-selling F-150 pickup by as much as 17%. Matt, what's up with that?
Well, they had raised prices massively on the Lightning. Remember, they were cutting prices on the Mach-E, the littler, I guess, crossover that they make. But the Lightning just kept getting more expensive. I was putting them together on the configurator. I spent a lot of time on these online configurators.
I bet you do.
And I was coming up with nothing less than like $80,000 if I was being frugal with like the Lariat version. But they get very expensive.
All right, so let's get into it, what's going on and what it all means. With us is Bloomberg News auto reporter Keith Naughton, who kind of smiled when he heard that Matt's spending a lot of time configuring different vehicles.
He knows me well.
He does. We all do. Also, senior equity research analyst at CFRA, Garrett Nelson, on the phone from Richmond, Virginia. He's got a hold on the stock with a 12-month price target of 16 a share. Right now, Ford trading, at 14 and change. Keith, come on in on this news. What's going on?
Well, so Ford is doing a couple of things. One, they are expanding the size of their factory that builds the F-150 Lightning to 150,000 units annually. So that gives them more volume, more scale, which enables them to lower prices. They also say battery costs have come down for them somewhat. But the other thing is there's competition coming. So you saw over the weekend, Tesla finally produced its first Cybertruck. But really more to the point, GM has been building the electric version of the Silverado since the spring, and they're now starting to pump out the consumer version of that. That's a direct competitor for the F-150 Lightning. And next year, Stellantis, the parent company of Chrysler, Jeep, and Ram, importantly Ram, will be producing an electric version of the Ram called the Revolution. So all the competitors are coming in. Of course, Rivian's already there. So Ford is feeling some pressure to protect the turf that it has built by being one of the first ones out there with its electric pickup truck. So they're cutting the prices.
So for me, the most important brand that Stellantis owns is Dodge, right? Because they make the Challenger that I love so much.
He's obsessed right now.
I'm pretty much obsessed with it. But that's old news, and in fact, they're not even
moving on to his next
they're not even going to make it anymore after this year, at least not in the current form. Garrett, what do you think about the popularity of the Lightning? I mean, they've been able to sell a ton of them, or at least take a ton of orders. Certainly a lot more than Rivian has sold, and I imagine that they're taking more orders or have more orders still in than Tesla, since the Cybertruck has been delayed for years.
Yeah, so the order count isn't the issue. Actually, Ford has said the reservation count for the F-150 Lightning is over 200,000 units. The problem has been a very sluggish ramp up of production. So they first started shipping this vehicle in May of last year. In that time, they've shipped less than 25,000 units through the end of June. In the second quarter, they shipped less than 4,500 F-150 Lightning. So they've been plagued by battery issues. They've just had difficulty ramping up, and they're not alone. Other automakers are having these issues as well, and a lot more competition, as was mentioned. First production of the Cybertruck achieved just a couple days ago. Rivian obviously has an electric pickup, some electric pickup products coming from both Stellantis and General Motors as well.
I don't know if Rivian can really be considered in the same breath as the Ford F-150 or the Chevy Silverado, right, Keith? I mean, it's a slightly smaller, way more yuppie vehicle than the others.
They call themselves the Patagonia of pickup trucks. It is smaller. It's closer to the mid-size, but you also sort of have to get into the headspace of the buyer of an electric pickup truck. It's not your traditional trucker. So they do cross-shop with the Rivian, even though it's a smaller package. There are tons of quirky things that people like about the Rivian, like that pass-through that's behind the passenger compartment that you can, fit a grill into or a surfboard or whatever. So,
you know what it is, right, Carol?
No, I'm
they
not
have
sure I did.
They have a hole in the side of the truck, and you can stuff something all the way through to the other side.
Love that.
Including a grill that you can pull out, complete with plates and silverware.
It's practical.
They also have, that truck has 850 horsepower if you get the fully built version, which is insane.
Could tow a boat.
Yeah.
Easily. Hey, so Garrett, come back in on here. So is Ford going to be losing money with these price cuts?
We think so. There's a price war happening in the auto market for electric vehicles, really started by Tesla early this year, announcing price cuts just after the new year, and that's continued. If you look at the average transaction price for an electric vehicle, in June, it was down 20% year over year. And so there's been significant price cuts across this electric vehicle space.
Keith, I wonder about the situation at Ford with regards to turning a profit. It doesn't seem like they really are trying to with this generation of electric vehicles, but they have a whole new generation coming. Will there be lower production costs when they get the plant in Tennessee up and running?
Yeah, they feel like they're going to get these huge volume improvements. And you're right. So Ford has said they're going to lose $3 billion this year on their EV unit, but they've set a goal to get an 8% EBIT margin by the end of 2026. During that same time horizon, they plan to increase EV production 15-fold to 2 million vehicles a year. Last year, they produced about 130,000. So they expect these economies of scale will help them achieve their margin target. There's a lot of skepticism among investors and Wall Street analysts about that.
All right, so the F-150 Lightning Pro starting at just under 50, still down about 10,000, or that's about 10,000 lower, but still above the original starting price at $39,974 when it went on sale back in April of 2022. Keith, help me out here. I mean, electric vehicles, the prices are going to have to come down, should come down, right, as they ramp up. I mean, Matt and I keep talking about how expensive they are. It makes it really hard for us to adopt.
I was talking to an analyst earlier today. That's the number one barrier of entry. We talk about charging, all sorts of stuff. It's the price, man. It's still luxury prices. And so that 50,000 one, the one that's just below 50 you mentioned, that's just for the commercial buyers. That's the contractor truck. That's not the one you and I buy. Mm-hmm. The one you and I buy is the XLT, and that starts at 55,000. So what if you want the gas version of the XLT? Well, that starts at 41,000. That's quite a delta. And they're sold in the same showroom. So you go into the showroom and you look and it's like, okay, do I want to pay an extra $15,000 to go electric? Can I afford to pay an extra $15,000 to go electric? You know, the question is, have we saturated the early adopters and now we're getting to the mainstream? And the mainstream folks operate on a budget. And can they afford what our luxury price is? Matt told you, he configured. He's not finding that $55,000 pickup truck.
Exactly.
It climbs in price very quickly.
I spend time on pretty much every configurator. I've been on Rivian's configurator probably 10 times. That doesn't mean I'm going to spend $90,000 to buy one of their trucks, as cool as it is. Garrett, are we all going to, though, be driving EVs, in 5 to 10 years' time?
I just got about 30 seconds.
Yeah, so we talk about how EVs are still much more expensive than internal combustion engine vehicles. That premium has come down a lot. If you look back 6 months, the average EV is about 25% more expensive than the average vehicle. That premium has come down, according to Kelley Blue Book, was only about a 9% premium in June. We think it's going to continue to come down as lithium supply increases, battery raw material supply and prices improve. And so, we think it's still some time before EVs reach price parity with ICE vehicles, though.
All right. Well, guys, thank you so much. Really appreciate it. Keith Naughton, auto reporter at Bloomberg News on Zoom in Detroit. Garrett Nelson, senior equity research analyst at CFRA Research. Gotta say, Matt, driving up and down the Connecticut coast, I just saw Teslas everywhere.
Yeah. Well, they've been around for quite a long time.
Yeah.
Let's get a check on the latest world and national news right now. For that, we go to Denise Pellegrini in the Bloomberg Newsroom.
Hey there, a lot of issues related to food security this hour because the wartime deal allowing Ukraine to continue exporting grain has ended nearly a year into its run. Russia has now terminated this pact and had a lot of complaints about it. Bloomberg's Amy Morris is tracking developments.
The move heightens uncertainty over global food supplies and escalates tensions in the region. Interfax reports Russia notified Turkey and the United Nations, which brokered the pact, that it won't extend the deal. Moscow had said it will return to the agreement once its conditions are met. The corridor's shutdown will hit key buyers China, Spain, and Egypt, and jeopardizes a trade route from Ukraine just as its next harvest kicks off. Ukraine is one of the world's top grain and vegetable oil shippers. In Washington, I'm Amy Morris, Bloomberg Radio.
All right, thank you, Amy. Climate and storms, a big topic here in the Northeast. Deadly flooding over the weekend. At least 5 people are dead. The death toll in Pennsylvania, including Bucks County outside Philadelphia, still could continue to rise. Across the border, across the Delaware and New Jersey, a state of emergency has been declared in some areas. New Jersey Governor Phil Murphy says talks are on the way to improve infrastructure in the area to handle these new, more powerful storms we're dealing with.
We've seen it, but not at this level. And I think we all fear that that's going to be the new norm. And we can't be dragged by that. We got to get out ahead of it.
And Murphy also says right now a lot of roads and bridges are out in that part of New Jersey. And here's the difference between a holiday week and a regular summer week. Workers who went to the office in 10 of the largest U.S. business districts rose in the last week to almost 50%, up 12 percentage points from that July 4th week when, I don't know if you take the train, but just about everything was empty then, and most offices were pretty empty too. Global News 24 hours a day, powered by more than 2,700 journalists.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing right now, with the S&P 500 index up by about 0.5%. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. Stocks have moved steadily higher throughout the session. The Dow is up 120 points, S&P higher by 20, with the NASDAQ rising 140 points. The U.S. 10-year yield is at 3.81%, and small caps are up 1%. 6 of the 11 main S&P sectors are trading higher, led by tech and financials, while utilities and real estate are the worst performers. Nasdaq Biotechs rise 1%, transports are up 20 points, semis are higher by 100, while the VIX is up 1%. Leaders in the Dow, Intel, JP Morgan, and Apple, while Verizon, Disney, and Merck are the worst performers. Ford Motor is among the worst S&P 500 stocks after slashing prices on its electric F-150 truck, while Activision rallied after Microsoft's planned takeover gained more momentum. In biotech news, argenx jumped 25% after successful data for its inflammatory drug, and BridgeBio surged 80% on upbeat results from a heart drug study. Wrapping things up, AT&T extended a sell-off to hit a more than 30-year low after Citi downgraded shares. Live from the First Word breaking news desk, I'm Bailey Lipschultz. Charlie?
All right, we thank you very much, Bailey Lipschultz. And to hear live breaking news over your Bloomberg, type SQUA, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, got just about 17 minutes left in today's trading session, getting ready to wrap up the first trading day of the week. Carol Master along with Matthew Miller live at Bloomberg headquarters in New York City. Matt, of course, in for Tim. Let's get to it. Our market guest on this Monday is Sue Crotty. She's Senior VP and Chief Investment Officer at Siegel Marco Advisors, and she is joining us on Zoom in New York City. Marco, by the way, Siegel Marco, I should say, is an independent employee-owned investment consulting firm. Sue, nice to have you here. How are you?
Thanks, Carol. Good. How are you doing?
Doing okay. Tell us a little bit more about your firm and who your clients are and who you're providing research and analysis to.
Generally, all institutional clients, defined benefit, defined contribution. We have over $60 billion of advised assets under our control, including both discretionary and advisory. We work all over the United States for some large pools of assets.
So, what kind of view do you take when it comes to the big macro questions? How much longer is the Fed going to raise rates? Where will we see a cut next year?
Yep, that's pretty much on everyone's mind these days, including all our clients, as they set their asset allocations and start to look ahead to what to do for the second half and then into 2024. Our feeling is that it's been a really interesting year. It's been a great year coming off the fact that we finally have real yields, which we haven't had, as you well know, for over a decade. We've always been in the camp that this short-term pain that we're going to feel as rates go up is long-term really good for the economy. It's really good for the financial markets, and it's really good for savers. It's really good for pensioners. It's setting the stage for what we think is a much more fundamentally driven environment that is going to be positive for everybody.
So
markets have come. Oh, go ahead.
No, what I'm wondering too, though, Sue, is trying to figure out, because I do feel like we know the Fed's coming to the end of this rate hiking cycle. I think that's a fair assumption, and you're certainly seeing it in the trade. But having said that, Jay Powell has reminded us, certainly in those press conferences, that the idea of rates starting to be cut and come down, that might be a few years out. What are you telling your clients who are, as you said, managing billions of dollars of investments? What is it? Do rates stay at this level for several years, or do they really start to come down substantially?
Again, question of the hour, right?
Yeah.
The market's not saying, the futures market's telling us they're still going to come down, at least next year. Finally, I've been amazed all year that, as Powell has been telling us, they're here for longer, and yet nobody believed it. And I think part of that's just, recency bias. I think it's part of it is a lot of people managing money have never seen this sort of cycle before, so they're not used to, the fact that you can have a positive return on bonds. There's a lot of people investing these days that didn't know that 4% is the long-term yield. So I think it's a lot of just getting used to the environment. We don't really believe it's coming down this year. I think, I believe what the guy says. We're very data dependent, and, the data is not there yet. So I do think we're closer to the end, as you just said. But I really think that this year we're going to see rates continue, barring any black swan. We were here, pre-pandemic with rates starting to level out again and get to reasonable levels again. And then we had a pandemic. So, nobody expected that. That was hopefully a once in a lifetime thing. So, I think we're back to us getting back to what has been in my 40 years of doing this, a much more normal fixed income environment. Just people haven't really seen it.
You think it's time to go out on the curve, get a little more duration here?
I think, you think you got to start doing it. It's very tempting to stay at 5%, but at some point you're going to have a roll up or a roll down problem, right? So, I think it pays to diversify your fixed income, and not just keep it all short. It's for the long term, it's going to help you.
So I guess what I'm trying to figure out is, and I think that's, like, as you said, rates and where they settle and what happens next, it's the $1 trillion question. Having said that, does it feel like the markets are a bit heady? I'm talking about equity markets, because it's not fair to just throw
at
markets
4,500 on the S&P.
Yeah, I mean, we've had quite a bounce
certainly in certain parts of it, for sure, right? I mean, this concentration that we've been dealing with again now, and this quarter, the whole AI hype, reminds me a lot of Pickett, memes.coms, you name it. The market is, when you get 16% plus returns, and 12.5 of that comes from 7 stocks, and not from earnings, right? That's all just multiple expansion. That's not really sustainable. But the good news and the flip side of that is that there's a lot of other stocks that haven't done well. I think if you take those 7 stocks, and that's 12% of the 16, there's another 5 that is all other 493 stocks in the S&P 500. So there are some good values in the market. It's just, this earnings season and the next couple of weeks is gonna give us a pretty good indication of some of the wares.
All right, we got
value, small, you name it.
Yeah,
we have not.
No, forgive me. You're right. No, we've been saying that earnings are going to be really important in terms of fundamentally what we get from the companies. That's something that investors can actually trade on, and what we get in terms of outlooks and estimates and so on. Sue, thank you so much. Sue Crotty, she's Senior VP and Chief Investment Officer over at Siegel Marco Advisors, joining us on Zoom from New York City. I mean, Matt, we're going to get some big earnings this week. I mean, we've got Netflix, we've got Tesla, we've got tons of names, and I think that's going to help us get a clearer picture.
You use the EVTS function.
Events.
Yeah, it's a great way to check out what earnings are coming. I type usually the
More
S&P
banks,
into the securities.
regional, big guys, Goldman, right? We're still waiting.
We're still waiting, yeah. Bank America is going to come out tomorrow. Bank of New York Mellon is coming out tomorrow. PNC Financial.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. As we have been telling you, the sticker price on Ford's F-150 Lightning electric pickup is being lowered by thousands of dollars due to increased plant capacity, falling costs for battery raw materials, and internal efforts to scale production by the Detroit automaker. The updated MSRP for the Pro model, its lowest priced electric pickup, will be $49,995, down from $59,974. So how does this play into the inflation or perhaps disinflation backdrop? Greg Dacko is chief economist at Ernst & Young.
We have seen that both used car prices and new car prices surged way beyond their pre-pandemic trends. We're starting to see some correction on that front, both in terms of new and in terms of used car prices. That is the disinflationary wind that we were talking about 6 months ago. The fact that once disinflation gets underway, it can actually surprise to the upside in terms of velocity.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. Ford shares, they are down now by 5.8%. Tesla shares, they're up now by about 3.1%. All of this comes as Tesla says it has built its first Cybertruck at its plant in Austin. That's almost 4 years after Elon Musk first unveiled Tesla's debut pickup. And those are some of the top company stories we're following for you at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. Getting ready soon to head over to our TV colleagues and wrap up the close. They're talking with Kathy Wood right now. Matt and I are going to be talking with her after the closing bell. A lot to get into when it comes to Tesla, Meta, things she's been buying, selling, fund flows, but also
Threads.
And her Twitter stake, writing it down, but still liking it long term.
Yeah, very interesting stuff. We're going to get a lot of time with her, so I'm really looking forward to it. She owns 5 stocks that have more than doubled this year. So wait, I just had them: Palantir,
Tesla,
Meta, Tesla, DraftKings, and Coinbase are all up more than 100%. Year to date. So she's been doing very well. Her funds have been doing very well. But as we know, people are pulling money out of them, which makes sense, right? I mean, buy low, sell high.
People do that. They actually do that. All right, so we've got a lot to talk about with her. So feel free to send us questions. You can email us. Certainly send us stuff on the Bloomberg. You can also send us questions on Twitter. So we would love to work you into the conversation. Just real quickly, Microsoft, we just want to mention, clearing another regulatory hurdle. I was working a little bit later on Friday night, and all the guys had to kind of readjust some of their weekend programming and weekend hits on the radio side, because it's like, wait a minute, it looks like, Microsoft, another big move forward.
Yeah, absolutely. After a deal with Sony, which was the biggest opposition to the biggest non-regulatory opposition to this acquisition, it looks like it can go forward. The UK is taking another stab at it. The courts told the FTC, forget about it.
Yeah.
Lena Khan, go home.
Yeah.
So it looks like they're going to make this deal, and I just wonder what it's going to mean for Call of Duty, because that's the only thing I care about in this respect.
Because, we're all just living in Matt Miller's world.
I mean, I'm sure there are reasons it's important for you, too. I just don't know what they are.
No, listen, it's a big deal for Microsoft, and so getting another step move forward on it is a big deal. All right, everybody, we're watching the markets. We're just rolling over on the equity side. Matt, we've got a lot of earnings coming our way, but there's kind of a risk trade on again a little bit.
Yeah,
just a little bit.
It is. Well, I mean, look, we're over 4,500 on the S&P, and strategists' average target for S&P year-end is 4,091. So
and I feel like all the strategists, too, or economists are saying, maybe we will have a recession. Things aren't so bad.
Yeah, well, Janet Yellen certainly says that.
All right, sit tight. Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, joined now by Scarlett Fu, as well as our colleagues Carol Masser and Matt Miller. Our global simulcast begins as we take you to the bell and beyond. Welcome to our audiences across Bloomberg Television, radio, and Bloomberg Originals as well. Carol Masser, interesting day here in financial markets. I guess a bit of a holding pattern. We are seeing a rally, but a bit of a holding pattern as I think we await a little more clarity on earnings.
Yeah, more conviction when it comes to the NASDAQ. We're certainly seeing that outperformance today, but I agree with you. We've got a week packed full of earnings. I'm just going to go to ARK, though, the innovation ETF. You guys just talked with Kathy Wood. We're going to talk with her after the close. It's up another 2.2% in today's session, so definitely some outperformance there. That fund, by the way, still way off its highs a couple of years ago, but it's up about 55%, Matt, this year.
So that's a perfect time to sell usually, right? When things are higher? Unless you think they're going to continue.
It's going to go higher, yeah.
Unless you think they'll continue. So I'm looking forward to that.
Well, we should point out, I mean, we talked with her, and I mean, I didn't kind of realize that it's kind of had a bit of a resurgence, at least in terms of its price return, outperforming the NASDAQ, believe it or not. Of course, the S&P and some of the others, though, is not outperforming things like CHIP, Scarlet, or the FANG index here. And I think that might be part of the issue here. Is there's a lot of competition for money out there right now. And, you know, I said to her, I was like, you know, when she kind of came to everyone's attention, she was kind of the unicorn, right? She was doing something no one else was doing.
Absolutely.
And where else were you going to put your money if you wanted that type of growth?
Now everyone's caught up and the obvious names are overbought. I mean, she basically said that was the case with NVIDIA, and they're looking at some of the other players that might have gotten left behind.
Yeah, we're going through some of the main holdings, at least in the flagship ARK-K, at least for today on this Monday. Most of them solidly in the green here. Overall, we have green across the board for most of the major indices here in the U.S. The Dow Jones Industrial Average closing out the day up about 0.2%. The S&P 500 higher by 0.4%. The NASDAQ Composite higher by about 0.9%. And the Russell 2000, that's your relative outperformer, a 1% gain even across the board.
All right, if I go a little bit deeper into the S&P 500, Romaine, you're looking at 275 names to the upside, 227 to the downside, Matt, and one unchanged. So a little bit more of a bullish tone, if you will, but almost an even split there.
Yeah, and it's an even split as well in terms of industry groups. We had, we had 5 gaining groups and 6 actually dropping. IT was the biggest gainer, so a good day for Kathy Wood. Financials and industrials carrying up the lead there. In terms of the losers, you had utilities, real estate, and communication services. So that's the streamers and such. But for the most part, people were selling off, investors were selling off the defensive sectors.
All right, folks, let's get to some of the individual gainers in today's session. And no pun intended, but solar stocks on fire. Don't hate me for that one. First Solar was up about 8%. I know, Matt. Go ahead. Well, is that not good?
That should be solar stocks.
I like it. I actually like it.
Solar flare, maybe?
Flare? That sounds dangerous.
Heating up, solar stocks heating up.
All right, see, we can be creative. We can all write those like bottom of the screen headlines. All right, so solar stocks, nonetheless, despite some price target cuts by Morgan Stanley, what happened was you've got First Solar coming out and Energix agreeing to buy a bunch of modules. It's about a deal, about a $1.5 billion deal, and so that gave some momentum into First Solar specifically, up about 8%. Morgan Stanley, though, just another story, cutting their price target to 180 from 200. First Solar closing at 206 and change, but again, up more than 8%. Enphase, it was the number 2 gainer, just behind First Solar in the S&P 500. These names also top in the NASDAQ 100. So Enphase, it was up about 6.5%. And that, again, despite Morgan cutting its price target to 234 from 268, maintaining its equal weight. But again, Enphase, an outperformer. It does report on July 27th. Both of those stocks, let's see, First Solar's up about 40% year to date. Enphase is down about 30% year to date. Real quickly, on semiconductor, hitting a record high in today's trade, up 4.7%. Top of the S&P 500 and NASDAQ 100. Citi raising its price target to 118 from 95. Stock closing at 104 and change. It's up almost 70% year to date. It reports later this month. What?
Nothing. I was just cutting you off.
Okay. Acumen Pharmaceuticals, small cap companies surging 54% in today's trade. Hold on.
Okay.
Company reported initial results from a dose-finding trial of its treatment for early Alzheimer's disease that met key goals. Alzheimer's, everybody's trying to figure out how to report it. All right, guys. Go ahead, do your thing.
Let's take a look at the decliners, because Matt mentioned communication services a drag on the index, and certainly that's because of the big telco names like Verizon and AT&T. Verizon down for an 8th day, AT&T trading near its lowest in about 3 decades. A lot of concern over their potential risk tied to lead cables. A number of analysts downgraded these names, including Citi, which said this will be an overhang for the next couple of months, maybe longer, until the market can better measure the risk. We're also looking at Rivian down more than 3%, falling for a third day. The catalyst for the decline is competition from Tesla's Cybertruck, which rolled off the assembly line this past weekend and has a lower base selling price. And ViewRay, the ticker is ViewRay, is a maker of radiation therapies. It was once worth as much as $1.5 billion, now worth about $14.5 million, sinking as much as 81% after filing for Chapter 11 bankruptcy, saying it plans to pursue a sale.
All right, let's check in really quick on what's going on in the Treasury market. And I guess some bond traders will be happy to know Not a lot of activity there, of course, coming off what had been a pretty volatile week last week. Most of the moves today relatively muted, down basically about 2 basis points on your 2-year yield, and you go longer out into the curve, and not a whole lot of change at all here. Overall, the Treasury curve is pretty much where we left it, guys, on Friday afternoon.
All right, so what's going to be our focus here, right? We've got a bunch of earnings coming this week. Tesla, Netflix, you name it, a ton of companies. You've also got some economic data, retail sales coming out, and some others. And I'm just thinking we've constantly focused on what we're going to hear from companies, Matt. We've also got banks, right? More banks coming out this week. Whether or not they provide some momentum to the upside in the equity markets. I guess that's really our focus, and whether or not there's more enthusiasm that continues to come into the trade.
Yeah, tomorrow we have Synchrony Financial reporting. We have Bank of New York Mellon. We have PNC Financial Services. We have Bank America. We have Charles Schwab. So it's really a focus on financials tomorrow. And I think it's good. We're solidly focused on earnings now and talking a lot less about the Federal Reserve and how many hikes or how many cuts.
Well, it's also because the Fed officials are in media blackout right now before their policy meeting next Wednesday. I was looking, and there are a couple of notes that indicated about 60% of the KRE, the ETF that tracks regional banks, will be reporting this week. So we'll get a really good read into how the regional banks are really dealing with the higher cost of funding. And 40% of OIH, which is the ETF that tracks oil services companies, will also be reporting this week. So it'll be very sector specific, but it does give us a good look.
And I'm going to keep an eye on IBM and some of the other folks in kind of that cloud software space, if you will, because there's been so much talk about consumer spending. Well, we kind of forget that there were some cracks when it comes to business investment, and whether that would actually now be the next shoe to drop, now that I learned what that means. But it'd be interesting to see whether that corporate spending really holds up, because, we all can't just sort of, depend on us, buying plane tickets or buying expensive jewelry.
Yeah, and I feel like, every time we talk with a strategist, if you will, what did you say about jewelry?
Nothing.
Oh, okay.
Have you been buying expensive jewelry?
No. Did you see Richemont's earnings? No, apparently nobody is.
Well, and the China slowdown, right? We go back again to that, right? We used to talk about all the luxury, when China was doing well, those luxury names did well. But I do also think about, I feel like the drumbeat about, kids, students, college students having to go once again and having to start repaying back their student loans, that's going to really impact the consumer spending picture.
Those kids aren't buying expensive jewelry, I guess.
No, but they're buying other stuff.
They're buying on loan, right? They're doing the buy now, pay later.
Yeah. Maybe.
Yeah, so I think it'll be interesting to see as savings rates come down, as stimmy checks have been completely wiped out, what happens to the consumer as well. But I don't think they're in such a bad situation.
Did you guys see the story? More Americans getting turned down for loans, according to some Fed data too. If you're looking for a place to maybe tap, if they're looking for places to tap so that they can keep on spending, that is also not happening.
Yeah, absolutely here, and and that data, I think, is kind of where the concern is when you talk about consumer spending, particularly in light of kind of the downdraft in that Chinese economic data. Before we go, though, I do just kind of want to point out, too, and I know, Matt, you've been all over this, but we've been talking about sort of the health of the auto industry and the cuts that you saw in the pricing on the Ford Lightning, F-150 Lightning, but also a lot of other automakers have really sort of started to peel back a little bit, at least relative to kind of the strength that we saw a year and a half ago.
Yeah, you're starting to see. I actually saw Dodge Challenger Scat Pack $7,500 off. Now the prices have soared over the last couple of years, but you're right. We're starting to see more and more discounts as I think demand is ebbed a tiny bit and production has picked up. That's really the key part of the equation.
All I'm saying is I need EVs to come down in prices because I can't afford them. I mean, right?
One reason I brought it up too is, my family and I actually went out and looked at some cars over the weekend, and I was surprised. I mean, we did this last summer.
Wait, EVs or regular?
And we didn't actually buy because there was nothing on the lot to even test drive, and then what they did have, there was just like crazy markups. Not necessarily this time around. The inventory is certainly there, and they all seem to be touting this idea that we're not going to gouge you completely off on MSRP.
They just need to come down, man. I'm just telling you. All right, guys, that's a wrap. Our cross-platform
drive, Carol, do you?
I do. I love
She
driving.
is. She loves driving.
But she lives in the suburbs. She has to drive.
I've known Carol the longest. I know what she drives.
Guys, we have to run.
I know what she drives, too.
That will do
Fancy.
it for our cross-platform. Beyond the Bell. We will see you again tomorrow. All right, we want to get right to it. We are so delighted to have back with us once again the founder, CEO, and CIO of ARK Invest. She is with us. We're talking about Kathy Wood, of course, on Zoom from St. Petersburg, Florida. Kathy, nice to have you back with us. I hope you're well.
Oh, thank you, Carol. Yes, we're doing very well. It's a good year, so feeling much better and happier for our investors.
Well, let's talk about that. You know, Matt and I were just talking before we got going. NASDAQ 100 up more than 40%. Best first half for the index. Investors are definitely chasing risk this year. Anything that feels euphoric irrationally in your view, that maybe we need a little bit of a correction here?
You know, what's interesting is to see funds having nice moves and flows not follow. I think there's a wall of worry out there. It is about further interest rate increases, what's going to break next. It's about a hard landing. It's about a hard landing in the context of now China and Europe really struggling, and how will that reverberate? So we actually think that, and we've been saying this for some time, that deflation is the bigger risk out here. And I do believe, I just heard your conversation about autos. I think we're going to see an unwinding of auto prices, that the Ford F-150 Lightning's price decline is going to be the first of many auto cuts that we'll see. And if you remember during the early stage of COVID and the supply shocks, at one point, the combination of used cars and new cars accounted for a third of the increase in inflation. I think you'll see that on the downside here. And we're going to get to 2% inflation, I think, much faster than many people think, with perhaps a harder landing, more for corporate margins than anything else. Because if you see these discounting and you see consumers respond to discounts, maybe real growth kind of, I still think we'll have a harder landing, but maybe with price declines, we'll stave that off, that hard landing, for a while.
Well, we were hearing investors today say that inflation is no longer concern number one. Growth is really what the market is concerned about now. And so you think we're going to have a recession, Kathy?
Yeah, if you look at real corporate revenue growth, it's down 1.1% year over year that was as of the first quarter. That is consistent with gross domestic income, down 1.1%. This is real gross domestic income, down 1.1% year over year. Gross domestic income and gross domestic product over time equal one another. It's an identity. But the information flows are different, and income, you get a lot from the IRS, a lot of income data. The product data, product and service data, is a little bit more sampled and erratic, but over time. So we could already be in that downturn, and the GDP numbers will just catch up later on.
What about the inflation numbers? I mean, we come down over the last year from 9.1% CPI to 3%. That's pretty quick. And, you know, I've talked to you a couple of times in the last couple of years, and you've mentioned a concern about deflation rather than inflation. Do you think we're going to start to see that coming as we see it in other major economies, most notably China?
Yes, it's very interesting that Chinese deflation is, so their prices are down, according to the PPI, 5.4% year over year. And I do believe they are going to export it over time. So yes, we do think we're going to see price deflation, but there are two flavors of deflation. There's good and there's bad. The good deflation has to do with innovation. And we have centered our research around 5 major platforms, all of which are technologically enabled and deflationary. And they're becoming a bigger part of the pie. Electric vehicle sales, for example, Tesla's making sure that it's passing along the cost declines from its electric drivetrains to consumers so that it can sustain demand. Anything having to do with innovation, the best companies are going to pass those costs along to the consumers. And so I think you're going to see much broader based deflation in not only the transportation sector, but perhaps everywhere because artificial intelligence training costs, AI training costs, are dropping, get this, 70% per year. Wow. 70% per year. Now, that's the good deflation, is causing booms in activity. But we do know that disruptive innovation will disturb or disintermediate the traditional world order. Think electric vehicles and gas-powered vehicles. You know, these auto companies, 90 to 95% of their revenues are still tied to the internal combustion engine.
So, Kathy, when people talk about AI, do you think it's going to upend the labor market substantially?
The history of technology over time is that it's a net job creator. In the short term, you'll see some displacement, you'll need some retraining. But I like to remind people about the internet. In the early days of the internet, when we were trying to figure out what it was and how it was going to work, we had no idea about Uber or Airbnb, businesses that could not exist without the internet. And I think the same is going to be true in the AI world as well. I think it's going to be a tremendous boon to productivity. It is the equivalent for knowledge workers of the assembly line in the industrial age. This is the new assembly line. And, you know, what happened because of the original assembly line? Well, a lot of people left the farms, and there are a lot of farmers then, and moved into businesses and activities that they didn't dream were possible before that. And I think the same will prove true now.
Love it. A little Henry Ford history there. I like it.
Love. No, but it's like this big picture. One thing I want to ask you, kind of whittling it down a little bit. You know, one of the things in the headlines today has to do about Dow Jones. You did an interview and you talked about Twitter and writing down your stake in Twitter by, I think, about 47% since Elon took it over. You're still bullish long term, so help me understand that write down against a long-term bullish view.
Sure. That we have no choice in this. This is we have a pricing committee. We calculate our net asset value for the ARK Venture Fund every day, and we get a lot of markers. There's trading on the secondary market. Less so with Twitter. We're trying to find some Twitter. We'd love to buy some at this level. But while Fidelity has marked it down and some of the other large managers have marked their positions down dramatically, based on, yes, we are still getting information about advertising sales not picking up dramatically yet, but they're in very early stage with Linda joining the team. We'd love to buy it. We think longer term, we think that Elon understands what a super app is. After all, he did get started in the payment space and sold his company to PayPal. In the last week, Twitter has gotten money transmitter licenses from 3 or 4 states, and they're going to cover the land. And you know, WeChat Pay taught us a lot about what a super app is in terms of not only information flow, but financial activities and commerce. So we think Elon has grand plans. And, you know, it's also been interesting. I think some of these markdowns may be a result of Threads. I don't know. I don't get involved in that decision making. But if you look at Threads already, the engagement activity is plummeting. I think people know that Threads is no Twitter.
You still have to love Meta, though, right?
You were buying, right? You were buying some Meta.
Yes, and not for Threads at all. We have bought, you know, as Tesla went up 2.5-fold in 6 to 7 months, as we always do, we take profits. It's still the largest stock in our portfolio. And we have our wish list out there. What companies are doing better than we expected? So Meta Platforms, you know, was disintermediated to some extent by TikTok. We had expected that, and we pulled away and avoided all of that loss. Now, that doesn't mean we avoided losses in innovation, because innovation was trounced broadly in 21 and 22. But what we are intrigued by is the shift in focus and priorities from metaverse to artificial intelligence. That's the first thing. And what has also been quite astonishing to us is the engagement levels among all of their properties, Facebook, Instagram, WhatsApp. They're pretty astonishing, very sticky. And so we can see why advertisers are coming back. That's kind of a safe play. They're leaving linear TV and finding other ways to advertise. And so we do think Meta is now back again, gaining more share in advertising.
You're all listening and watching Bloomberg Business Week. Carol Massar with Matt Miller. And of course, we're talking with the founder, CEO, and CIO of ARK Invest, Kathy Wood, on Zoom from St. Petersburg, Florida. Kathy, help me out. Like, you and I have been talking for a long time, Matt, and you have talked for a long time. You know, when the world follows you tick by tick, as you know, and we know at the end of a trading day we can get an idea of what you guys have been buying and selling. You sell Tesla, you buy Meta, you sell Shopify, you buy Block, you sell DraftKings, you buy Robinhood. What is it that is, you know, the long-term, innovative, disruptive plays that you are always keeping on your radar? Which are the ones that you're now putting in the rearview mirror?
I see. All of the trades you mentioned were around the edges. We're still very positive on those stocks. Typically we're taking advantage of some opportunities that the market is handing us. I will say when we were concentrating our portfolios towards our highest conviction names in 21 and 22, which is what we always do during a bear market, we thought we would revisit more of the names, especially in our ARKQ strategy, the autonomous technology and robotics strategy. And we find now that those are pretty good sales because we don't want to get back into many of them. And an example in that regard are NIO and XPeng in China in the electric vehicle business and aiming for autonomous. But they have not been able to compete with BYD and Tesla and have fallen on hard times. And we also, because of that, are not as sure as we were that they would go for it and make some strides in the autonomous space. So again, innovation's moving very quickly. And if the innovators aren't quick enough and technologically savvy enough, it's easy to lose in this fast-paced game.
I wonder about crypto in terms of, you know, things still to materialize. It seems like a lot more people are getting on board with you. Who was it? Larry Fink was on Fox Business, and he was saying, you know, basically everything's going to be tokenized. This is going to help the finance be more frictionless. And it was, I think, fascinating to hear, you know, someone who controls the biggest firm in the financial industry globally to say things like that. We know that you're in Coinbase. That's one of the stocks that's done so well for you this year. But where else do you see good opportunities here, given the regulatory scrutiny it's had under Gary Gensler?
Well, I think what's happening first with crypto that is wonderful in terms of the United States. While we were very unhappy with Chairman Gensler's direction, we're very happy that the judicial and legislative branches of our government are questioning the power that he seems to have seized and are questioning whether he should have a right to do and say some of the things that he's doing. So that's good. I think the Ripple ruling last week was a big win for crypto, another huge judicial branch weighing in. So we own Coinbase, as you know, but we bought it when we saw the Wells notice and the SEC suit because we believed, and it turned out to be correct, that the judicial and legislative branches would start to weigh into this discussion. We also own Square, which has a business dedicated to Bitcoin, and it's going to be the Trojan horse to get into other economies, especially emerging markets. This is Cash App to get into those markets. So those two names, but one of the reasons you are, I think, hearing Larry Fink wax more eloquently on the crypto space, when at one point he, I think, was calling Bitcoin a Ponzi scheme, is that there are now Bitcoin filings at the SEC. And we have one, BlackRock has one. So I think that's another reason we're hearing more from these more traditional players. DeFi, decentralized financial services, is a risk for these centralized players. So they're trying to play ball and actually use the technology to lower their own cost base. But they, as a centralized institution, do not have the DNA we think it will take to really succeed in decentralized financial services.
So, Kathy, does Coinbase, in your view, become kind of a bridge between traditional finance and the DeFi worlds?
Or Ripple?
Now, yes, it is. It's developing something called Base. And definitely understands both worlds. It's going to be, we think, a major institutional on-ramp into the DeFi space. And, we're hearing more and more, where there's smoke, there's fire sometimes. Certainly was true with Terra Luna and FTX, but, we're hearing more turmoil when it comes to Binance as well. With Australia and the Netherlands basically banning it, as effectively we have done here in the United States. So think about the share gains that as an on-ramp that Coinbase will enjoy if anything untoward does happen to Binance.
So when you sell Coinbase like on Friday, is it just, again, taking some money off the table because of the incredible run?
Yes, it's portfolio management. When something is up fourfold from where we had been buying it, we will take some profits. It's now the number 2 position in the flagship strategy ARKK. It's number 1 in ARKF, our fintech strategy. So we become opportunistic at those moments in time, and very often you'll see us buy something, as you saw. We talked about Meta, that is also up a lot, but in which our conviction has increased because, again, in the case of Meta, change in priorities. So
don't you think that's what investors are doing with the flows as well, Kathy? Because, last year, ARKK came down a lot in terms of its price action, but the flows were just piling in. Investors were still buying. And so this year, your funds have done very well. They're up 50, 60, 70%, depending on which one you look at. And I get that people would take money off the table.
And so do we. And they're taking money off the table, in many of the funds that we're compared against and that we measure ourselves against. And yet the focus on ARK alone is interesting. It's a phenomenon, and it makes sense. Yes, have had a big run. Now, one thing that's happened recently for us is we had seen a basing of, we'll use ARKK, but it's true of all of our strategies, a basing in a range, mid-30s to mid-40s, mid-30s to and so we saw, profit taking a 45 and moving back in mid-30s. Well, we just broke out of that 45 range. So actually in the last, it seems like a lot of, I don't know if they're technicians or investors who use technical analysis, basically are saying, oh, it broke out of the range. And I do think that's why our flows are now back in July.
So, Kathy, the reporting, we've done it, Dow Jones has done it, others, about outflows in your funds since October. So you're saying that money's coming in at this point?
Turnaround.
Yeah, and you can see our ETFs. We report them every day. The flows are reported every day. So I think for the flagship, it's around $250 million just thus far in July. So yes, and before that, we understood people were taking profits, just like we take profits in our stocks. As you were saying, Matt, this is nothing new. However, there's something else that could be going on here. And that is, if you look at the NASDAQ and the Qs, they're not too far from their all-time highs. Whereas our strategies, and let's take the flagship, ARKK, the all-time high was close to 160, and we're still below 50. Sure, maybe the 160 was a bit too far, but I think our funds were disadvantaged because they don't look like the NASDAQ or the NASDAQ 100. And as the markets were selling off last year, more people, more investors tried to get closer to their benchmarks, and they were selling our stocks and buying the big mega cap techs and so forth. I think that might be changing. I think real active management is starting to evolve here or have more of an impact, because even though we don't own most of the mega cap techs, in terms of the Magnificent Seven, really Tesla is our major holding. And we do have 25% exposure to healthcare, which is negative year to date for the sector. But for us, it's somewhere in the 25 to 30% appreciation range. This is active management at work, as well as SMID. We're much more tilted towards SMID cap, smaller and cap stocks, and those have underperformed the mega cap techs. But our strategies are outperforming the NASDAQ 100. So it's saying something to us about true active management beginning to make a difference again.
Crypto has, we've talked about it, but Bitcoin in particular has certainly been on a run here. We always love to, and I love because I get a lot of responses on Twitter when it comes to your price for Bitcoin. I think you recently revised from about $1 million to about 1.5. Where are you on the price for Bitcoin?
And by the way, I was talking with Tim Draper last week, who's obviously a Bitcoin maximalist. He's pushed his target back a little bit.
Yes. So the numbers you referenced, so last year when we did our big ideas, so this would be 2022, it was north of $1 million. And what we've done, because of the FTX fiasco and all of the FUD and regulatory pushback, we went to a bear, base, and bull case. So our bull case is, I think it's 1.5 million. The base case is 625,000, something like that. Now, one reason we've actually internally, our confidence has increased towards the bull case is because of what happened during the regional bank crisis in March. What happened? Bitcoin, so as regional banks are going bankrupt and the stocks are imploding across the board for the KRE, Bitcoin rallied from 19,000 to 30,000. Why did that happen? That was a flight to safety. That is the insurance policy that we are talking about, that we believe everyone will want at the end of the day. Insurance policy against two things: confiscation of wealth, either directly or by inflation, or in the deflation world, what is it a hedge against? Right. It's a hedge against counterparty risk. We won't have an 0809 with Bitcoin. Everything is decentralized and transparent. No obfuscation.
All right, I'm going to squeeze you, and I apologize ahead. 25 seconds, your best new idea right now.
Oh, our best new idea. Gosh. You know what? We've been trading around ideas. I suppose the one we've put in recently to ARKK, a new one, is one we had before, but Teradyne. It's involved in two things: semiconductor tests, right? And AI is causing a boom in semiconductors, and automation, universal robots. And we think that boom is just starting, industrial robots.
All right, so appreciate it, as always, and I know you gave our TV colleagues some time as well. Kathy, be well, and so appreciate it. Kathy Wood, of course, of ARK Invest. Be well, be well. All right, right now, let's get a check on world and national news. Off to Denise Pellegrini in our newsroom. Hey, Denise.
Hey there, Carol. Well, New York City's air quality is fluctuating. It is unhealthy for sensitive groups intermittently today. The warning is up. Forest fires, of course, still raging across Canada, sending smoke south. Other major cities across the I-95 corridor are also impacted. It's worse in Pittsburgh and across the Midwest right now and could get worse here as well. It's a huge day for insurance adjusters today here in the Northeast. Damage assessments underway after massive flooding in some areas over the weekend. At least 5 people dead in Pennsylvania, including in Bucks County outside Philadelphia. In New Jersey, landslides wiping out roads and bridges. In Connecticut, hundreds of acres of crops are still underwater this hour. And Connecticut Senator Richard Blumenthal says that means watch for rising produce prices.
People take for granted that there's going to be affordable produce on their table. We can't take it for granted.
And Blumenthal is also calling for reforms to the National Flood Insurance Program for better coverage for small farmers with multiple crops. One long-shot Republican trying some attention-getting moves, don't they all? This one offering a slate of potential Supreme Court nominees. And we'll have more on that coming up for you here on Bloomberg Radio. And it's official. New York City has its first Latino police commissioner. And during a ceremony in the Bronx today, New York City Mayor Eric Adams officially introduced Edward Caban.
Together, we will build upon our successes and continue to drive down crime and improve the quality of life in our communities.
And global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Denise Pellegrini. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 index, and the Russell 2000 all advanced today. Stocks resumed to rally as investors weighed bets that the Fed is approaching the end of its interest rate hikes against evidence pointing to a slowdown in China's economy. Bottom line here, the S&P 500 index advanced 17 points, up by about 0.4%. Adding to last week's gains amid optimism, the Fed may soon be able to claim victory over inflation. The Dow up 76 today, up 0.2%. NASDAQ up 131, up by about 0.9%. 10-year yield 3.80%, with a 2-year that's yielding 4.74%. Spot gold little changed at $19.54 the ounce, down just about 60 cents. West Texas Intermediate crude down $1.33 a barrel, 74.09, a drop there of 1.8%. Now, what about the higher rate environment? What does it portend for the equity market? Sue Crotty is Chief Investment Officer at Siegel Marco Advisors, and she was a guest right here on Bloomberg Business Week.
We've always been in the camp that, this short-term pain that we're going to feel as rates go up is long-term really good for the economy. It's really good for the financial markets, and it's really good for savers. It's really good for pensioners. It's setting the stage for what we think is a much more fundamentally driven environment that is going to be positive for everybody.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Among the big banks reporting tomorrow, we will be hearing from Bank of America. That stock up today by 1%. Also reporting tomorrow, Morgan Stanley. Morgan Stanley shares up 0.7%. Wednesday, Goldman Sachs up by 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Matthew Miller on this Monday edition of Bloomberg Business Week. Matt, of course, in for Tim. So, artificial intelligence, it's on everybody's mind.
Oh, yeah.
Oh, yeah. And that includes when it comes to the German business software giant SAP and its investments in AI. So recently, that Jefferies wrote in a note to clients, they kind of pointed this out and the importance of it. Shares of SAP up around 40% year to date. So let's get into it and the company's overall strategy. With us is Julia White, Chief Marketing and Solutions Officer at SAP on Zoom from Bellevue, Washington. Julia, nice to have you here with Matt and myself. How are you? And tell me kind of what's front and center when it comes to strategy for you guys right now.
You bet. Great to be here. And thanks, Matt and Carol. Certainly, as you said, AI is on the top of everyone's mind, and how we, particularly as a leader in enterprise applications, create AI solutions that help businesses run better, right? That's the core of what we do. And now this new generation of AI, a lot of new opportunities to do so.
So, I imagine you're investing almost more than anybody else in this space because it's such a slam dunk for your customers. What are you able to do with AI that you weren't previously?
You bet. And it's multifaceted, right? Us, like, as you said, we're doing so much around AI because a lot of the company's most important business data is sitting in an SAP system, right? Your AI is only as good as your data. And that's why you saw us very quickly out the gates, striking partnerships with folks like Microsoft and Google and IBM and other AI players as well, because while they have incredible AI engines, we have incredible data. And you bring those together, you can unlock, great business outcomes. So to your question, one really simple example that just immediately happened was logistics, right? We have manufacturers with huge manufacturing plants all over the world. You'd be surprised that a lot of that's still paper-based, and a lot of rekeying as a truck pulls into the manufacturing center, rekeying and information. Now we're using AI, scan the document, use Gen AI to understand what it is, and take a process that might have taken 30, 40 minutes down to 3 or 4 minutes. And if you combine that over, a year over a manufacturing plant, you're talking about $1 million a plant in savings they're getting just that quickly, one single use case. And again, we're just starting that exploration, but you see outcomes like that, it's really impressive.
So how do you guys, though, square this idea of there's still a lot to be known, or do you not care that you just assume that everybody's going to be pursuing AI because they have to, because if they don't, they're going to get punished by investors, and that just means more uptick for your services, whether it's, you know, data analysis or being able to manage that data or manage it in the cloud. So it doesn't really matter whether or not we don't quite know the impact of advanced AI, if you will, but they're just going to have to be using your services.
I think we have I'd say a more responsible approach to that. I mean, we're dealing with companies' most mission critical systems, their finance systems, their HR systems, right? This is incredibly sensitive data and systems. So I know, and we've been on this AI train for many years. Obviously, generative AI is new, but AI itself is not. And so, for example, we worked for over 18 months a couple of years ago to go customer by customer to get explicit consent around how we use their data to train AI models, and did it in a very transparent and explicit way. I think you are seeing some vendors, unfortunately, just like popping up a screen and saying like accept, and we don't think that's a particularly responsible way to do it. So we really laid this foundation so that now with generative AI, we can move fast because we've laid that groundwork and had a very responsible approach in how we're thinking about it. Because this is, again, customers' most mission critical information.
Julia, you talk about responsibility in terms of your approach, but I do wonder, is it that you're kind of, do whatever you need to do in terms of investing in AI, the AI area, at the expense of margins, because it's kind of where you need to be and you don't want to miss the trend?
I see. Certainly is a big investment area, and from directly within the company, but also like our venture partnership with Sapphire Ventures, $1 billion investment in technology there, as well as partnerships. So kind of R&D investments as well as partnership and ecosystem investments. So yes, we are full steam ahead to make sure that we're capturing the capabilities that we can. And when you start to see value being created so quickly, you see that it's going to pay off.
But I mean, so not so focused maybe on margin improvements because, you've got to be here in terms of the investments in AI.
Yeah, I mean, not margins, irrelevant, but certainly willing to lean in and make sure that we're creating those use cases. And then obviously got to have an eye on cost always at some level. but yeah, it's about invention right now for sure.
Can you reduce your costs significantly with AI at SAP? I mean, I imagine you have a large army of, highly paid coders. Eventually, you should be able to replace them with fewer that use AI.
I think we have a number of internal experiments going on or use cases going on across all the disciplines from engineering, marketing, sales. And I think there's a lot of efficiencies for us to be gained internally as well. I'm not going to go so far as saying, hey, we're not going to need developers. I don't think that's the future or the situation. But how can we drive efficiency? How can we do less with more? More with less? I think there's some real opportunity. I look at it when there's a big transformation to public cloud, right? All the people who used to rack and stack servers, now they're able to go do new things that are adding more value to the companies and to their customers. And so I expect, like any other big tech transformation, there's going to be a lot of new jobs created and a lot of existing jobs that are transitioned.
Julia, is every conversation with a client or customer does it start off with AI?
More or less. Yes, it's top of mind. I mean, that being said, the macro growth through a challenging economy, continuing to deliver on their promises to their customers and investors, that the digital transformation journey is still very, very large. But how AI helps them with that now, very much the conversation.
What's the differentiator, SAP versus Oracle or your other competitors? What makes SAP better?
Yeah, I mean, a couple of things. Like first, we look at how do we make it more relevant, right? AI for AI's sake isn't what we do. How do we put it in the context of work, like the transportation example I gave you, right? It's just part of the applications we deliver. The other uniqueness is, AI needs to be really relevant, which means you have to have the right data and the right data with context. And that's something, again, SAP systems know that it's not just a data field. What does that mean in your business context? Or AI can be smarter and not have hallucinations. When you're dealing with finance information, you can't get different outcomes based on how you ask the question, right? It has to be accurate in that way. And then I really do think maybe the strongest differentiator is around our responsible approach. I really think we're leading the industry in how we're doing it.
All right, we got to run. Hey, listen, thanks so much. Appreciate getting some time with you on this Monday. Julia White, she's Chief Marketing and Solutions Officer at SAP, joining us on Zoom from Bellevue, Washington. Carol Masser, Matt Miller, and this is Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pettit. BlackRock plans to give millions of U.S. investors more voting power at shareholder meetings after taking heat from both sides of the political spectrum that the firm has too much sway over ESG issues. BlackRock shares today down less than 0.1%. Tesla says its first Cybertruck has rolled off the assembly line at its plant in Austin, Texas. Bloomberg's Ed Ludlow is following the story.
This is 2 years behind schedule. I'll never forget being in Los Angeles for the unveiling of the Cybertruck. You know the images, the metal ball against the window and it's smashing. And the plan at that time was to start production within 2 years. Well, it's kind of almost 4 years down the road. Deutsche Bank forecasts that Tesla will ship around 2,000 units of the Cybertruck this year. But in the scheme of things, they're also forecasting that overall Tesla will ship 1.78 million units.
And that's Bloomberg's Ed Ludlow reporting. Tesla directors, meanwhile, including co-founder Elon Musk, have agreed to return more than $735 million in stock awards to settle an investor lawsuit accusing board members of improperly giving themselves massive compensation packages. Richemont led luxury goods stocks lower amid concerns that demand in the U.S. and China, two of the biggest markets for the industry, is starting to sputtering. Richemont is the Swiss owner of Cartier. Today we saw Richemont shares, the ADRs in the U.S. down 9.7%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Matt Miller here in the Bloomberg Interactive Broker Studio, in for Tim Stenivek. Carol Master, of course, alongside me. We got a lot coming up still, including Joel Weber and the Business Week crew with their story on Vanguard and the, what do they call them? The Bogleheads.
The Bogleheads.
Bogleheads. It's a big deal here,
Love it, Jack
Vanguard.
Bogle, yeah.
Everybody in the whole country basically knows what Vanguard is because
Totally.
we all have access to Vanguard through our 401ks. But in Europe, it's a different story, and it doesn't look like they're making a heck of a lot of headway over there. So we'll touch base with Business Week on that. Right now, let's get over to Denise Pellegrini in the Bloomberg Newsroom here in New York. Denise?
Yeah, the White House, Matt, is now denouncing those comments by Democratic presidential candidate Robert F. Kennedy Jr. Kennedy, as I'm sure you've heard, is said to have claimed Jewish and Chinese people were the most immune to COVID-19, and he calls it a bioweapon. White House Press Secretary Karine Jean-Pierre calls the remarks an attack on fellow citizens that fuel anti-Semitism and racial bias. And Kennedy's sister, Carrie Kennedy, also piling on and criticizing JFK Jr. Cleanup underway after more floods in the Northeast. 5 people dead after heavy rain in Bucks County outside Philadelphia. In New Jersey, landslides have wiped out roads and bridges, and Kelly Canfield in Belvedere, New Jersey, says her house is buried under up to 8 feet of dirt, and she says the situation there is still unfolding.
We lost vehicles. The basement's flooded. Now the second story is starting to, like the rug is starting to get wet and everything.
And further north in Connecticut, hundreds of acres of crops are underwater. Governor Ned Lamont touring the damage in Glastonbury, talking about the need to harden the state against weather disasters.
So that we just don't go back to where we were before and hope the next storm is not as bad as the last storm. See what we can do to mitigate some of the damage for farms just like this.
You know, we've already seen the hottest June on record. That's one of the things Lamont is also worried about. Now July has 10 of the hottest days in history. Bloomberg's Amy Morris has the latest on global weather scene from Washington.
Simultaneous heat waves are stifling the U.S., much of Europe, and parts of Asia. El Nino is intensifying in the Pacific, while the Atlantic waters near Florida topped an unheard of 90 degrees. NOAA says 22 of the past 23 years were the hottest ever. Right now, 2023, 2020, and 2016 are all vying for the record. Climate scientists warn that the only way to stop this trend is for people to immediately and dramatically reduce their use of fossil fuels. In Washington, I'm Amy Morris, Bloomberg Radio.
All right, thank you. I mean, of course, what happens when it's hot like this is instead of reducing energy, people crank up the AC. So anyway, we're doing that here for sure. Guys, back over to you.
Absolutely, man. My air conditioning, my air conditioning's been on forever already. It's like crazy. I feel like I go from winter to almost...
I keep it on in the winter. I like it to be teeth-chatteringly cold.
I'm like freezing here. Give me a heater. Give me a Snuggie. I am cold. But
just wear a suit.
Yeah. Yes, just wear a suit. I'll work on that. Yeah, I think that's interesting what she said. You know, we've talked about this, right, already, that the year being on track to be the hottest ever. There was I'm trying to think who had, is it Jason Aldean? Am I saying it correctly? Performing artist, right, who had to shut down his concert in Connecticut because of heat exhaustion. Yeah. It's just crazy how warm it is.
Well,
and we're not
the one thing that I find
kids.
so interesting is that when it gets this hot, everybody jacks up air conditioners, all joking aside.
And
everyone who can.
the grid's all ready for it.
And the grid is